colleagues, business leaders, and influencers. I'm Liz Harper, and I am the partner in charge of the Sobel Co. Employee Benefits Plan Audit and Consulting Group. I thank each and every one of you for being here with us today. We are very pleased to be able to welcome those of you who have known Sobel for a long time now, as well as those that are new to the Sobel community. Today marks our 5th annual Employee Benefits Plan Symposium. Today, we are not meeting at the country club as we have in the past, but virtually from our homes or offices. And I'm very hopeful that next year we will have the opportunity to meet in person. Before we get started, I would like to express my sincere appreciation to all of those who generously helped to make this event come together to become a success. I will turn it over to Sally Glick, the principal of the firm, who will introduce you to the panel.
Thank you, Liz, and it is a pleasure to be here as well. As we prepared for this symposium, we talked about what are the most important factors that are impacting today the plan administrators and record keepers and everyone involved in the retirement plan world. And we have 4 unique perspectives that we'll be able to present today. We're going to talk about some of the key, most important factors from an audit perspective, tax perspective, investment, and ultimately record keeping and / business issues. Very fortunate to have 4 amazing panelists with us who can each discuss these unique perspectives. We have Brian Gregovic, we have Elizabeth Liz Harper, we have Frank Palmieri, and we have Allison Smith. We'll also conclude with remarks from our managing partner, Alan Sobel, who will bring us all back tied up together and giving us a perspective in terms of everything that we've heard today. So I'm going to turn to the panel, and we'll start with the first of those 3 pillars. And Liz, I think we'll start with you. Considering everything that's happened, particularly during COVID, cybersecurity is a word and a term that keeps coming up over and over again in every conversation. In regards to a retirement plan and an audit perspective, which is your unique role, what is it about cybersecurity that's so important?
Thank you, Sally. So the importance of cybersecurity is it permeates all of us on a business level as well as on a personal level. With the most recent cybersecurity attack that has impacted us, from efficiently getting our gasoline if we live in the South to the supermarkets or the various department stores that we shop at. It's really, really important. And why why this topic continues to be of importance is because retirement plans have a significant amount of dollars in them, and that it's just cybersecurity in itself is just a really hot topic. So I'll start back when this topic became very important in 2016. The chief accountant at the Department of Labor had asked plan auditors to speak to their clients. And so today we continue to see the various breaches and personally identifiable information, PII, is really what somebody would be targeting. This type of information is at the core of a retirement plan, and it includes your name, your address, your date of birth, your social security information. And with a recent poll, as of just early in 2021, there are over $3 trillion of assets in various plans. So it really does make it very attractive to the white collar criminal. So I'm going to start by talking to you about my 5 recommendations that really highlight some areas of cybersecurity, and that you should, if you're a plan sponsor, you're in the role of HR director, you should really make sure that these are evaluated and covered. So the first item is cybersecurity insurance. And what I will tell you is that you should, at a minimum, just evaluate the need to have that cybersecurity insurance, not only for the plan, but for the company. So that is very, very important, and you should just evaluate it. I've also actually heard that the premiums are not overly bearing. They're pretty reasonable, and you just really need to truly understand what it covers. So the second item I will say has to do with strong access controls and policies by clients, that it's actually not that cost prohibitive. So it really is something that you should evaluate if you are a plan sponsor. Secondly, I would say strong access controls and policies. So what I will sum that up is a few years ago, Sobilco actually implemented dual authentication, so that, and what I will say is that in this work from home environment currently, we are all working from home and, reaching out and entering our company's IT infrastructure. So more than ever, it's really, really important that you have strong controls over that. So the third item I will bring up is cybersecurity awareness training. We instituted that a few years ago. Again, it's really good. It's eye-opening. Professionals as well as professional staff, it's really important that they understand like what an email, a phishing type email could look like, because if they just click that link, it could send them off, and it could be really very expensive for the firm, not only from financial standpoint, but resources, right? Because you're not able to function and complete the work that you need to. So the fourth item I will say is be very careful where your assets and your information is stored. Scrutinize service control organizations that you work with, such as I'm looking at Allison, I will say, Principal or Fidelity, or if you use ADP, like your payroll providers, you have to make sure that you understand the controls at those organizations, right? And there are some things that the teams, right, the plan sponsors and their HR teams and their accounting teams should do to gain an understanding of those SOC reports. And then lastly, I will just say, just have business resiliency. Understand, and we all encountered this with Superstorm Sandy. Events can occur that are out of our control. And I think as I look to the future, I feel confident COVID is behind us, but I question like what is going to be the next event that's going to take us off our chairs and really push us down again. But I think we show that we're all very strong.
You're on mute.
Okay, so the last item I want to share, yes, is the EBSA, which is the Employee Benefits Security Administration from the Department of Labor, is just recently issued cybersecurity program best practices. They listed 12 best practices. We're going to be sharing those with the audience, and I would think that it's a really good read. It's something that you should share internally. It's not just for benefit plans, it's for your entire company.
Great.
Thank you so much.
Thank you, Liz. And Frank, you're going to be up next, so you need to take off your mute and tell us a little bit from that legal perspective. Liz made a point of saying, even if COVID's over, something's down the road. The one lesson we've learned is that nothing is certain. So from that legal perspective, why is cybersecurity so critical?
Well, cybersecurity, I was going to start off with saying that it's sort of ripped from the headlines, as Liz said, in connection with the recent ransomware. So it's all hot in our heads, and we'll touch a little bit also on what Liz mentioned in terms of the Department of Labor. But I'd like to start off with the best thing for most of our clients, quite honestly, is having good collaboration between Liz, the CPA, Allison, the record keeper, Brian, the registered investment advisor, and legal. I find that when you have at least a once a year meeting where everybody is in the room and present with the client, you tend to minimize errors. And everybody, as we said today, comes at things from a different perspective. So I think the clients do get the best overall result when they get to hear different points of view. With that, data security, if you think about it, is really not new. I go back to the late 90s when HIPAA was enacted. If you look what happened there, suddenly we had protected health information. Didn't really have it before that. I guess Nobody really thought about it. 2002, the privacy rules came in, which controlled data and data in paper form. 2004, the security rules kicked in, which deal with what we're talking about today, electronic data, EPHI. What did we do then? We really have to do the same thing, and it builds on what Liz said. We really have to go back to the basics. We have to look in our organizations where the information flows, who touches it, how does it get passed on. We need to set up procedures the same way we did them back then for purposes of HIPAA. We need to focus on how we protect that data. We need to focus on, the physical provisions of locking doors. I mean, remember in those days, we actually worried about fax machines. I mean, I don't know how many of you still have fax machines on your desk, but now we have electronic fax machines. So you have to go through basically the same process. And as much effort as we all put into it, from the vendor standpoint, from the employer standpoint, the amazing thing is that one of the biggest sort of breaches recently was a record keeper, and the record keeper had all the insurance company, not principal, had all the proper protocols in place. But what did they do? They had a data room, and some of the employees wanted to smoke, so they propped open the door so that they could go out on the balcony and smoke. So as much data security as you possibly could develop and try and implement, there's always going to be something that happens like that makes you scratch your head and say, how could this occur with all this training? You do need to look at your service agreements. As Liz said, the Department of Labor has been, subject to some criticism for dragging its feet a little bit on data security, but now it's finally come out with some guidance on April 12th, and Liz focused on some of the tips that you're going to get in the materials with regard to selecting vendors and checking on vendors. But two other parts of that also had tips for record keepers and even plan participants. How can plan participants protect their own data? So I think this is just going to be an evolving process. Again, it's not anything really new. From an employer perspective, you don't want to have a breach. There is no uniform reporting of breaches to HHS like you have under HIPAA, but you also have to realize that since then, we actually do have a significant number of laws that deal with data security from the state level to the federal level. So when you do have a breach, it's probably a good idea to regroup with your advisors and make sure you're mitigating it as best as possible. And obviously, we're all trying to protect participant data, participant assets, and making sure we don't have a black eye in the press. With that, I probably used up my 5 minutes. So Sally, you can pass me along.
It's just perfect. Thank you, Frank. And of course, as you point out so cleverly, collaboration and now communication, especially during COVID, is more important than ever. It makes it harder to stay in touch and share the important information. So it's one of those golden morsels you have to remember and make yourself a note, is collaborate and communicate no matter what. And everything that's old is new, right? Everything that's happened has somehow happened before. So Brian, let's look at you and talk about that investment perspective. It's cybersecurity, and why does that matter?
Yeah, and you hear all this good stuff. I mean, between Liz and Frank, they obviously touched on all the good points around cybersecurity and where we're heading, and it's kind of interesting. I feel like we're always about 3 years behind, right? When we get in the retirement industry, 3 years ago, you heard about a little bit of talk about financial wellness. Now we're there, right? You're kind of in the heart of that. You heard about cybersecurity about 2-3 years ago. Now we're in the heart of it, right? The EBSA comes out with their set guidelines. So, I feel like this is, we're right on track, right? To where, how the retirement industry works. And everything, Liz and Frank says, they're spot on. I look at it from a perspective of, well, there's so much information there. How do I get my hands around that? And I think that, the number one thing I would say to everybody is, this should be part of your committee meeting process, right? I know everybody should be having committee meetings to talk about your retirement plan, go through your investment reviews, go through your plan demographics, look at your fee benchmarking. Everybody has an IPS probably, right? Investment policy statement. Maybe you have an EPS, an education policy statement. I know I've heard of FPSs, fee policy statements. Well, maybe there's a CSS coming, a cybersecurity statement coming, right? It could all be part of your investment, your investment committee process. So I think that's the best place to start. And one thing I'll add is, Liz and Frank mentioned about the guidelines coming out from the EBSA. Well, the number one thing on there is have a formal, well-documented cybersecurity program, right? So using your committee meetings is a great way to establish that program for yourself. So I know us as registered investment advisors, that's now part of our normal process. If we're meeting with our clients twice a year, sure, once a year at least, we're going to talk to that cybersecurity review. People like Allison and at Prudential, they've got great programs in place there. Have that conversation with them once a year. Ask them, hey, what have you done to update that? They'll be happy to share it for you, because it is a big area that plans need to focus on nowadays. So I think just to simplify the process for you all and to say, hey, there's so much to worry about here. Well, how do I get my hands around that? I would say start with your committee meeting process. Think about how you can incorporate that into your process to make sure you've got that covered. Oh, and by the way, as you do that, now you're documenting it in your minutes, and you've got good, clear, definitions and guidelines established within your fiduciary files to help protect you against these cybersecurity, kind of breaches and stuff. So I think I'll stop there and pass it on to Allison.
Well, it was such a practical approach and so many hands-on important information that feels like common sense, but sometimes common sense is not all that common. So we're really glad that you emphasize those important factors. And Allison, you're a step ahead of me. You've already unmuted. So you're ready to go. Why don't you talk to us from that record-keeping perspective of clearly cybersecurity is an issue for everyone. Why specifically and uniquely from the way that you're looking at things?
Well, and I thank you, Sally. I think one of the biggest things when you talk about cybersecurity, most people actually look at the record keeper, because the record keeper is the one that's holding the information and has that duty of care to preserve the information and make sure that it isn't violated. There's really three things that on a day-to-day basis, at Principal am asked and are on top of minds of most plan sponsors. It's how are my employees going to be able to retire, and how can we make sure they have the right experience? How can I make sure that my fiduciary responsibilities are maintained? And how can I reduce the cost of this overall program? And normally cybersecurity is not on the top of their list when they're thinking about some of these things. They're thinking about the fund expenses. They're thinking about education meetings. They're thinking about lots of other things. But we've mentioned the new guidelines that have been published by the DOL a couple of times. And one of the language that's in there, and I actually wanted to read the commentary that he said this much needed guidance emphasizes the importance that plan sponsors and fiduciaries must place on combating cybercrime and gives important tips to participants and beneficiaries, and it goes on. The reason I think that's important is that they're calling out fiduciaries, that this is part of your fiduciary obligation. So bullet point number one, that when I say fiduciary, the fees or the participant experiences, they've basically thrown down the gauntlet and said, this is part of your fiduciary responsibility, and here's a set of guidelines that you need to make sure you look at. They divided that into three categories. One is, how do you hire the right service provider? And part of that piece is making sure that you have a service provider that has good audit control procedures, that they maybe have a SOC 2. The second thing is, what are some other cybersecurity best practices? And in there, they talk about making sure that you have that documented process that Brian's talking about. And then it talks about online security tips that are geared more towards participants. So in there, the other thing that comes along with that is, if you do these things, not only do you protect yourself from a fiduciary basis, you can really help protect yourself from an expense basis. Well, how? Well, first of all, a lot of the lawsuits are out there, and they've got plan fiduciaries, providers pointing fingers at each other for lost participant records. One of the most famous ones that's out there right now is the one that's against Abbott Labs that people have heard about, where a participant or someone who was a fraudster came in, changed the bank account information on a participant's account, tried to make a withdrawal from that account. The service provider said, no, you can't make a withdrawal because you have to have that bank account in there for at least 7 days. They called back a couple of days later, asked for the withdrawal, and the provider on the phone said the address to the person rather than have the person, the fraudster, say the address to them. And then they were able to get the check sent to a different address and make sure that they got the money, and the money was taken out. And now it's all of this participant's money, which was over $300,000, that was gone. And to this point, some of that has been retained. But when you think about that, kind of that third bullet point I mentioned was making sure participants are able to retire successfully. So if you do literally everything right that all of your service providers tell you to do, and your participants are on track and they have all the money they need, you don't want them to lose it at the last minute because of bad policies and procedures. And the last one I just want to comment on is that fee piece that I touched on a little bit. Making sure that you have someone that can stand behind you on a service provider perspective. It can't just be trust. It has to also be that there are procedures that are in there. And you have to know what that looks like. And having a low cost, but maybe not good procedures is not the right fit. But having a good fit of lower cost, but making sure that they've got some skin in the game in the event that you ever did have any kind of a breach is really important. So I think it checks all of your boxes. It's becoming more important, and agree very much so with the commentary of making it part of your fiduciary responsibilities because the DOL's already done it for you.
Thank you, Allison. And that example hits so close to home, right? Everyone has had something or someone they know or some organization hit by that. The fraudsters are incredibly clever. Just when you think you're one step ahead of them, they come up with something else, and you find they're actually one step ahead of you. So caution, caution, caution. Like Frank said, don't even forget to close the door on your way out. And every one of you has had such important comments. Thank you. Liz, thank you for using the chat box and sharing some insights. We're going to switch gears a little bit and go on to bucket number 2. Behind door number 2 is a question about designing a successful post-COVID. Liz said COVID's over. So you heard it here first, post-COVID plan to maximize tax benefits. And Frank, you can take yourself off of mute, and I think we'll start with you from the legal perspective. What is that plan going to look like?
Well, I'm going to steal one of your lines, Sally, when you said, what's old is new. I think we're in a perfect storm here right now. We have employees working from home, so we're sort of losing a little bit of that employee loyalty. We're trying to keep employees engaged, while they're working from home. Unemployment rate is low. We want to reward our important employees because they tend to drive each company. I always say 5 or 10% of the employees really drive the bus at each company, and everybody else is on the bus kind of going for the ride. And then we acknowledge that tax rates are going to increase. So the points that I'm going to make, and I'll try to make this as understandable in English as possible, and I probably won't touch on all the topics. But number one, which I'm going to cover, is I really think we need to reevaluate our retirement plans and possibly focus more on profit sharing than the match, although the match has been what's been driving the industry for the last 25 years. I think we're going to see also a return to defined benefit plans, even primarily at the smaller end of the market. But I think even the middle market can sort of benefit from the concept of old pension plans or the more popular cash balance plans. And I think adding a few of those thoughts together and then backtracking, I think the large accounting firms, the large law firms really have all evolved to a point of having a 401k plan and an add-on cash balance plan that gets tested with a 401k plan. So you're really maximizing benefits for all your employees. And why do I say that? Let's take a typical example. You got a company with 150 employees, 20 million in assets. Brian will tell you that that's a nice average account balance. I see him nodding about 133,000. perfect client, for Brian, and we'll get to that in part 3. But they've got the typical 50 cents on the dollar, up to 6%. So, and no profit sharing. So if you look at that, start with the non-highly compensated, somebody making 50,000, putting in 6% is 3, getting their match is 1,500, $4,500 is not bad. It's almost 10% of pay, but is that really going to get that person where they need to be? Maybe not. Look at the highly compensated, making close to 290 or 290 and above. They're putting in their 19.5. They're getting $8,700 as a match. They're walking away at the end of the year with 28,200. Is that going to really get them to maintain the lifestyle that what they need? And so what I think some companies should think about is eliminating the match. Those employees who want to save are going to save. You can still have auto enrollment and all other features. But if you use the profit sharing component, for the highly compensated person, we can go up to $58,000. This person is right now at $29,800. We're leaving $34,700 on the table that we can give that person. And there's a concept called new comparability or cross-tested. It's been around since the early 1990s. Our firm got one of the first private letter rulings to show that it actually worked. And what you do is you can put your employees into different rate groups. So there is basically what they call a gateway contribution. I'll call it a free pass. If you give your non-highlies 5%, you can basically do almost anything you want with your highly compensated, sucking up that $34,000 that's not being utilized, 28,000 that's not being utilized, and get most of your senior execs up to the maximum of 58,000 plus the 6,500 if they happen to be over 50. So how do the numbers work? Well, take the non-highly compensated. Before they were getting a $1,500 match. Now they're going to get 5%, which is 2,500. That's more than they were getting before. And if they continue at the same rate of saving their 6%, they're better off. You can also use this to reward long-term employees. You take the administrative person who's making 80,000 a year and has been with you 15 years. And we all know that without some of our admins, we wouldn't be able to operate at all. You can put a special contribution for that person based on years of service, or again, as a separate rate group. So the only thing I'm just trying to say is maybe we need to think a little bit differently. We can combine this 5% with a 3% safe harbor, 100% vesting, and not having to worry about discrimination testing. There's lots of ways that we can work with it, but I see it as something that we may need as we're fighting for employee talent, and we're trying to encourage savings, and we're also really trying to help our senior execs and everybody save on taxes. Think about it. You give somebody a 2-3% pay increase. By the time they take out Social Security, federal, and state taxes, they're walking away with nothing. You put that same amount into the retirement plan, you're saving FICA tax on both sides. You're giving somebody something that Allison can show on the monthly account as real increase in value. So I'm just saying we need to think maybe a little bit differently. I'm going to ask Sally to cut me off when you have to, but again,
it's a great place to conclude.
Right. Am I done?
Finish your thought.
All right. Well, again, just adding on to that, the concept of if you give those same employees 7.5%, you can actually add on a cash balance plan to your 401k and get some of your senior people literally an extra $200,000 plus a year, depending on their age. So I think, again, large law firms, accounting firms have been doing these concepts for quite some time, but I think it's finally time that it's going to filter down to the lower, smaller market, and I think it's really going to fill a void in helping to retain employees. Sorry for going over.
Thank you for speaking English and not legalese. I think probably everyone appreciates that. And the practicality of the example and the obvious, the stunningness of the numbers would give anyone pause to think. When you say maybe we need to think things in a different way, it is clear that we absolutely do. And Brian, I'm glad that you're off mute, because we'd like to have you come at this same exact question, of course, regarding the tax implications from the investment side of the plan.
Yeah, and I'm looking at it more from a participant perspective also, meaning, you know, when I think of post-COVID, or when I see what happened throughout the COVID situation, and you really think about, you know, where the markets and the volatility we had last year, right, where we saw the Dow Jones as high as 30,000 in March of 2020, drop almost to 18,000, I believe, at the end of March or early April, only to come back and finish the year up over 30,000. I think now we're in the 34,000 range, right? Despite yesterday's 500, almost 500 point drop, but let's not talk about that. But you know, but what's interesting is, you know, we saw opportunity in, you know, in 2020 to really help participants more with the support and education that they needed. And why I say that is, you know, for so long, if you really think about the way education guidance had worked, you know, most advisors such as ourselves would, you know, we'd set up some time, we'd come to a group meeting, maybe it's targeted to certain groups, and then, you know, you leave that meeting and nobody ever really does anything. They go back to their daily busy lives. So what you know, what's happened in 2020 is virtual meetings, right? It allowed us to open up more one-on-one opportunities to speak with participants, and that really kind of resonated a lot with a lot of our employees. You know, we saw a high volume of calls in March, April, and into early May, right? Come in. Participants wanted to know, hey, with this COVID situation, what do we do about, you know, about our accounts? How do we continue to do I continue to save? I'm not sure if I'm going to continue to get a paycheck, right? Things of that nature really came about, and, you know, it gave us an opportunity to connect with those participants. So I think I look at post-COVID as a great opportunity to be able to, you know, relook at your financial wellness programs, your education, your guidance programs, and to really think about it. And I tell a lot of people, you know, my job used to be, I used to go from, you know, client to client. I would spend hours a day in the car. Now I can run a meeting from 10 to 10:30 and be on another meeting at 10:31 and another meeting at 11:31, right? It's great. You know, there's so much less downtime. There's so much opportunity to be able to connect with your employees. So I think this is a great opportunity. Matter of fact, what's interesting is Schwab actually did do a survey around how this, and they found that there was over a 207% increase of employees getting on and obtaining some type of financial wellness education virtually than what they did in 2019. So, you know, I see post-COVID, this kind of created an opportunity for everybody to relook at how their plans are set up, how their education programs are running, and to be able to really kind of say maybe there's opportunity to expand upon them and be able to help those participants. So to Frank's point, you know, when we're looking at maybe redesigning a plan, well, how does that really affect the participant, and how can we now sit down with that participant and help make them understand the benefit that, you know, employers are giving them as they increase their plan or change their plan, or to Frank's point, if they're getting a match of 3% or a profit share of 3% and a match of 4%, that's 7%, and they're putting away their own 6%, right? Now they're up over at 13%. Is that enough to really get them to where they really need to be to meet their savings goals? So I think this, nobody wanted COVID-19, but, you know, if you've got to look at some positives that came out of this, I think this can be a positive that a lot of plans can take away from it.
A great point, and it is clearly a silver lining in this cloud, that the opportunity to be more strategic and to devote more time to planning for yourself as individuals and working with your advisors, and the opportunity for those advisors to communicate more effectively instead of trying to interrupt the day, kind of be one part of the Zoom day that they're already in. So thank you for that, Brian. And Liz, you've got a lens on that says auditor. You got auditor right across your forehead. What's your perspective on this?
So I'll just start out by just giving a really high level statement that I think is a good takeaway. So I see that we have clients on today's webinar that are small. They have small plans. Others have large plans. My big takeaway is it's more important today than ever to make sure you pay attention to the plan, right? Really read through it, because what you as a plan sponsor really need to do is ask questions. So from the lens of an auditor who asks questions all day long, what I'm going to suggest to you is like ask yourself questions such as like, what are your goals, right? Are you ultimately, like if you're a small company, how are you trying to take care of the owners and and you know the business, and either way, like how are you trying to, what do you want to give to your employees, like what's the end result, right? Are you tax driven? Frank suggested some really great tips for you just to consider. I think that we get stuck in our ways, right? And now it's a great opportunity for us to look at it through a different set of lenses to see whether or not like we should change something, right? Plan design doesn't have to be sophisticated or complex, but you should just think about it and spend the time. And you know what, it's a good exercise to go through, and you may realize that you actually don't have any changes to make, right? But it's better for you as a plan sponsor to be able to feel comfortable with that decision, right? So what else? So things that could have happened over the last few years, like were you involved in any mergers or acquisitions or entry into a new business? That's another question. So my takeaways for everyone is really just, determine like, are you happy with what the plan offers your employees and your business owners and the owners of the company, right? The employer match. So Frank spoke about an employer match, and I think that we all have different views on that. I think that it's a great suggestion to just analyze it and see, like, does that make sense? Should we have a component that is some sort of profit sharing, right? I think when we started out March of 2020, we were fearful. We were fearful that businesses were not going to succeed and that many businesses were going to have a lot of challenges and difficulties. Going to tell you that at the firm, we have many clients, and yes, some have been very challenged. It's very difficult for them, but many others have actually done better than ever because they've cut costs and they really have taken an approach of being efficient and effective. So, really that's all I ask is everybody really take a look at what you're offering today and see if maybe you should make some adjustments to it.
Given that everyone has always been so rushed, I think it was Frank or Brian who said by 7:30 you're already in your car. No one takes time to review and to consider and to rethink. And this is that magical time that we didn't ask for, but that landed in our lap. So I really appreciate the good points you've raised. Allison, you get to sum up this second category here from the record keeping point of view. What is the role and how can you be engaged in tax strategizing?
Absolutely. Most of the speakers have said you need to take a relook at your plan design post and just 2021. Normally plan design has been a set it and forget it kind of conversation. You set a plan design in place years ago, it rolls forward for you every year. And that might have been a good strategy for a long time. There's a lot of new legislative options. Your demographics of your employee base have changed. There's a lot of opportunity to get a better fit for the organization. And I want to give just a couple of quick examples of that. The first is that a couple of the speakers have talked about the match. Something very practical that we have seen on the match is making that match actually accomplish a goal of what you want it to. Normally, you want it to help you recruit and retain your employees, so match is a great opportunity for that. But you also want to make sure that it increases participation to the level where people are securing their retirement and also making sure that you don't run into testing issues for some of your highly compensated employees. The average match, though, is somewhere in the neighborhood of 50% to 6%. That's what we normally see. And to give some stats around it, it's not exactly the 50% to 6%, but we have study at Principal that talks about what the average deferral rates are based on matches. So if your match is 100% to 2%. So the total budget in all my examples is going to be 2% of pay. Your budget is, or if your match is 100% to 2%, the average deferral percentage rate for your participants is 5.14. If instead you stretch that 2% and make it a 50% to 4% match, same 2% budget, the average deferral percentage goes up to about 5.7. Okay, so it's a more, but not material. However, if you stretch that 2% to 25% up to 8%, the average deferral percentage goes up to 7%. Almost 2% higher deferral by your participant by stretching your match is the first thing you get out of it. They're better prepared for retirement, and your average rates are higher, so your highly compensated have a better chance of participating to the full effect that they can. The other thing that is there, remember my budget was 2%, but my average deferral was only at 7, and they had to do 8 to get the match. So the cost of your match went down. Better for the participants, better for your overall testing compliance, and the cost of it went down. And in fact, with one client where their match, and when we were starting to talk to them, their match that they were paying on an annual basis was about $1.5 million. When we put in the stretch match at the beginning of this year, the figures are looking out to be somewhere in the neighborhood of about $1.2 million. It's almost $300,000 of match savings where we're getting all of these greater benefits. And we were able to implement auto enrollment because they didn't want to do it at the smaller amounts because then the match would be too high. But if we were able to auto enroll people with the stretch match, we were able to get them in without necessarily having to cost more money to the company. So that's number one, is that plan design can have a material cost impact. And very frequently when people talk about cost, they're talking to their record keeper or their TPA about saving a couple $1,000s. Plan design can save you potentially hundreds of thousands of dollars depending on how you're working through it. The other thing I wanted to share was that Frank talked a little bit about how you can really structure a plan to get more tax benefit. And cash balance plans are an excellent opportunity for that. But another opportunity that is a great 2021 opportunity to evaluate is a non-qualified option. And that's a plan that you can set up for your executives, and it's limited to the top 15% of your workforce. And if it's a good fit for your organization, it can allow your highly compensated employees to defer unlimited additional amounts of their income, which in the event that the tax rates do increase could be very, very interesting for a lot of highly compensated participants. And again, it just depends on the organizational structure on if it will be a good fit for you or not, but it's something that's really worth evaluating. And if you did evaluate it in the past and maybe didn't go forward with it, having a 2021 lens on that evaluation makes really, really good sense overall. And then finally, I'd look at when you talk about plan design and what makes sense in COVID, there are a lot of things that you can add or promote, back to Brian's point about how do you engage with your participants, that could be very beneficial. Great example for that in 2021 is the Roth provision in your 401k plan. Roth is going to allow you to have your contributions grow tax-free once you have that Roth contribution. But what a lot of people don't know is that you can also typically, just depending on your plan design, allow for an in-plan Roth conversion. So you can take the $500,000 that you've had saved for your entire retirement and slowly start to pay the taxes on that by converting it over to Roth. There's no income limitations within the 401k plan, but what that can allow you is almost to dollar cost average your tax bill over time in a way that really makes good sense for you. So it's an excellent opportunity to talk to your participants, make sure that they're aware of it if you have it. If you don't have it, it's a great feature from an estate planning standpoint to add to your plan, and it can add a lot of value depending on what's happening with tax rates. Sally, you're on mute.
I clicked it, but I didn't double click. Thank you. And I'm glad that you're watching over me as much as I'm trying to watch over you. It's really important, everything that you said about the employee, right? We don't want to lose sight of the employee and the employee benefit planning. And I know there's a Harvard Business Review case study done years ago on profitability chain, that the profitability of any company starts with satisfied employees. And so when you have engaged employees and satisfied employees and you're doing everything you can, and as you so clearly demonstrated what the stretching does and how quickly or easily you can change the direction and the amount of savings that someone can have, it's important for people to be recognizing those and taking advantage of all of them. So thank you for that. Everyone's perspective is so different and so critical, and coming together It creates one big picture. It's wonderful to see the different pieces of the mosaic fitting in. And thank you, Colleen, for putting the symposium booklet in the chat room, as we had mentioned. So be sure to everyone download that before we're through and have as much information as you can, particularly about our speakers. So we're going to go to bucket number 3, and that is the key fiduciary concerns that you're facing and others in the plan administration role. And Frank, I think we'll go back to starting with you again, and you're on mute, so okay, take that off. Everyone's really been fantastic about remembering except me, so that's good to know. And tell us from that legal perspective again, what's going on with some of those fiduciary concerns?
Sure, happy to. Well, everybody on the phone knows that the only thing the Department of Labor cares about is transferring money from employee account to salary to the plan trust as quick as possible. I mean, you can get compensation wrong, eligibility wrong, vesting wrong, distributions wrong, everything wrong. The DOL won't bother you because they actually don't really understand that much about those issues. They're more IRS issues, but getting the money in fast is important. So, you know, Liz, you're always putting together the contribution timelines, and this is the one where you do have to report it by filing on the 5500. It reports it's late. You do have to prepare a form 5330 to report it. There's no de minimis standard, and you will get a letter from the Department of Labor encouraging you to participate in the voluntary fiduciary correction program if you're late. If you don't respond to the first one, they're going to send you another letter, and it's our experience if you ignore them, eventually they're going to come and give you an audit. So that is the number one, you know, fiduciary issue to deal with. The second one that I'm finding that more important is the world has been driven, you know, by two things, you know, on the retirement side for the last several years. One is the DOL fee disclosure rules, which came out many years ago, and then all the attorney litigation. The attorney litigation is because they have realized that they can go to the DOL website, look at 5500s, identify who is overpaying, and bring lawsuits. The attorneys are not really interested in helping participants. They're interested in getting legal fees and getting some benefits back to the participants. But if your fees are high, you really need to be evaluating them on a fairly regular basis. And Allison and Brian can both help you in that regard. I want to go back to
Frank, you're on mute. Frank, just unmute again.
sorry, but how'd that happen? But anyway,
No, there was some back noise, and so I think we got muted.
no problem. Bottom line, I'm going back to my hypothetical before, 150 employees, 20 million in assets, nice average account balance. You know, 10 years ago, that employer would not be getting fiduciary advice to monitor the investments, to watch list investments, to change investments. But with the litigation, you know, and Brian, you can pipe in later, we're finding that even at that level, they're engaging registered investment advisors. It used to have 100, 200 million before anybody wanted to have, you know, a registered investment advisor sort of help them. The other issue is to look at how your fees are being charged to participants. Allison is a lot smarter than me, so she invests all of her money in the index funds and therefore pays nothing toward record keeping. Frank Palmieri believes in active money management, so I'm investing in all the funds with high internal expense ratios, and I'm paying $500 or $1,000 a year toward the record keeping fee for the plan. So, you know, what a lot of companies are doing, and some of my colleagues will touch this if we have time on the end, is they're doing fee levelization. They're charging the same fee to all participants. So my point is, whether you as the employer are paying 100%, which I think is a nice thing to do if you can afford it, particularly at the smaller and mid-sized companies, whether you're charging it back to participants as a per participant fee and showing it on a statement, or if you're using fee levelization, you really do need to understand how the fees are being charged, because I think that is going to be future litigation when participants actually realize that they've been paying for the cost of their retirement plan for the last 20 years and they never sort of really understood that option. So I'll save at this point, I'll save some comments. I think Allison made some good comments. I do believe in Roth in-plan conversions. I don't believe in deferred comp for 2021 because at 36%, take your money and run. But I agree with Allison 100% in 2022 and beyond, our execs are going to go back to deferred comp. So probably used up my 5 minutes again.
I love your crystal ball, though. It's a great crystal ball. Liz, and thank you. Thank you for all of those. It's amazing to me how much we can pack into 5 minutes. You know, we talk about drilling down deeply and think you'll never get there, but everyone has done such a great job of sharing such critical information. Liz, again, you are typecast as the auditor. I can't imagine why. And there are some, of course, fiduciary concerns, as Frank has set the table for you. So why don't you tell us a little bit about what your areas of challenge are?
Right. Thank you, Sally. And being the auditor, I see we have we had 9 minutes, 3 people remaining, 3 minutes per speaker. So I want to make sure we stick to the agenda. Going to cut back my 5. I had a top 5 audit concerns, and I'm going to go with the top 3. What I will tell you in this environment, what's going to be very important for companies is to make sure that they fully understand the changes that occur to internal controls because of the COVID environment. And now employees are working from home and employees are working remotely. So it's very, very important that they understand, since this is a conversation on plans, who's responsible for, monitoring and transmitting, processing the information relating to contributions and distributions. So just make sure my takeaway here would be to make sure you document and fully understand how those processes work internally. The next item that I want to focus on is really changes that occurred in 2020 relating to employer contributions. You want to make sure that those were done correctly because many of our clients, they might have suspended the employer match or they changed the employer match. So as an auditor, we love to look for when those changes occurred and make sure that they're being done now correctly and in compliance with the plan agreements. So that would be my recommendation. If you don't have an audit, you should do a self-audit and you should make sure that it's being done correctly. And maybe now you're in 2021 and you're like, you know what, we've overcome the challenges and our business is profitable. Let's reinstitute the match. You want to make sure that that's also done correctly and in accordance with the plan amendments. So that is number 2. Number 3, Frank stole the thunder. I will still say that the timeliness of contributions is very critical. What I will also point out, and Frank, I guess just emphasize the importance of remitting timely. And what I will tell you is it's your track record. So if you can demonstrate that you can remit within a day, you should always remit within a day. And any outliers, you really have to truly understand, what do they do to? During the COVID environment, the Department of Labor did have a special ruling that allowed, I will tell you that it's really on an exception basis. You have to be able to demonstrate and document in writing what happened. An example could be maybe your payroll department was furloughed, or you didn't have anyone that could process payroll. You'd have to really demonstrate that and document it in the files. So that would be my next takeaway. Just be very conscientious, because if you're going to have a Department of Labor or an IRS auditor look at your plan, that is going to be one of the first items they look at and review. Thank you, Sally. Sally, you're on mute.
If there is any lesson that we have come away from COVID with, it is demonstrate and document, and document and demonstrate. If you knew it before, you certainly, it's on steroids now, because it's clear that that's critical in every issue. So thank you bringing that point up, Liz. It was really important. Brian, from an investor advisor's perspective, there's a bunch of stuff going on here that impacts the responsibilities of the fiduciary and their concerns. Tell us what you're seeing.
Yeah, and it's a lot of the same that we've seen for many years now, and and Frank alluded to some of the lawsuits out there, and I would think Frank would probably agree that if you look at the majority of the lawsuits that you see out there, it's really around a couple areas, and one, it's going to be about investments, right, and and not necessarily performance, but the fees that are associated with that, right? So I mean, I think that's where we see. So what I think last year did for us also, and has added from a top fiduciary concern is we've really had a good market for really since I think 2008. Market's been fairly good, right, for the most part, year after year. I think last year we got a little bit of a stress test in our accounts, right, in our investments. So as you're reviewing these investments every year, I think it kind of gives you a new perspective to look at them, right? How did participants and how did the investments fare as we saw some of that volatility across the market? Because what tends to happen in those types of situations is participants overreact. And if they're overreacting and moving their investments around, and you've got investments within that plan that may not necessarily truly be suitable for participants, maybe they saw, they could have gotten, really hurt by that, by some of those moves. So I think, we're still looking at top, from an investment perspective, do you still have the right design of investments in the plan? We've seen, for many years, and Allison mentioned before, the whole set it and forget it mentality. And we've seen for many years that on an investment, from an investment perspective, investments are set and they're like, oh, well, my investments are good, right? Or you don't really look at them. But things change. I'd like to say we're the best investment picker ever, right? And we never have any of the investments we pick underperform. But no, of course they do. And if they are, then great. Then it's the right time to reevaluate that investment and let's make the appropriate changes. So I think to be able to kind of sit back and look at your investments from really a larger picture, from a design perspective, that's number one I would kind of focus on. And number two, and Frank mentioned fees. Really, there's obviously, investments come in so many different share classes, and really the only difference in those share classes is the fees that are really being applied to that. So, are you using the lowest share class fees? But I would also say it's not always about that lowest share class, right? And I think Allison has mentioned, right, should you take a deeper dive and say, okay, well, if there is some revenue sharing going on, is that revenue sharing appropriate for your participants? Is there that fee equalization going on right across that? It doesn't necessarily mean the lowest share class fees are really the best for the plan. You could have use some of the higher share class fees, and your expenses could even be lower. So I think really taking that deep dive into all those features is an important aspect that plan sponsors really should be looking at on an annual basis, at least, to say, do we still have the right lineup in place? The last point I'll make is, target date funds. Let's throw it out there, right? They're still probably the most widely used investment, right? By participants. And, if you really ask me, I think it's probably the most suitable investment for 85% of the participants out there in across retirement plans. But, with those target date funds comes a lot more oversight. There's so many different flavors of them. There's two target date funds. There's through, what's the underlying allocation, what's the glide path like. So I think from it continues to be a top fiduciary concern to make sure that you're doing the proper due diligence on those target date funds, because, and again, remember, most of you are probably using those as your QDIA, qualified default investment alternative. So participants are getting defaulted into them, and so it becomes an extremely important aspect to have some oversight over.
Early on in your, when you just started speaking, you said something that was probably one of the most profound statements we could hope for. You said, things change. And I think that's that's the whole idea bringing together of all of this conversation today is things have changed, and how do we continue to do our best? So thank you for pointing that out. And Allison, you have asked for this great last slot here to be able to kind of sum up and tell us, from that practical business perspective, What are those concerns? And we've seen some solutions and ways of addressing issues. What are you seeing?
Yeah, absolutely. I think that I just want to echo what everyone else said. I think Frank and Brian said it well on looking at the share class of your funds. I oversee a region that will have about 300 to 600 new companies do business with us a year. Probably about 95% of them are written with zero revenue share classes, maybe another 5% with a very minimal amount. That's the last piece. The other 5% is what Brian's talking about, where they'll still use revenue, but they'll do revenue equalization. So it credits back to the participant, and a very minute percentage is doing it where it's not the same that every participant's paying. So if you're in that environment, it's worth evaluating that piece of it. And I think the long header is, what are your operational control procedures? That's something that when an auditor comes in to understand how your plan is operating, what are your operational control procedures is one of the first things that they look at. Operational control procedures are all the things that everybody's been talking about, making sure your loans are done right, your contributions are made on time, making sure your profit sharing allocation has been tested, and all these things just to make sure that it's happening appropriately. Many plan sponsors don't necessarily want to do some of those things anymore. And a lot of them have already delegated a lot of those responsibilities off of their plate. They're not processing loans. They're not doing hardships. But what liability assumption have they also given away? And I found with most contracts, they're not actually giving away that liability. They're just letting somebody else do it, which means they still retain the liability, but someone else is actually doing it. So I think that from a fiduciary perspective, a lot of plan sponsors are evaluating, should I have an independent administrative fiduciary, the same way that I have when they engage someone like Brian, where they have an independent investment fiduciary because they're not investment experts. Should they have an independent administrative fiduciary? And that's something where if you're finding it's a struggle to get your 5,500 done in time, contributions timely, any of those things done in the right order, that it's a really good opportunity to evaluate that and make sure that you have good operational control procedures if you don't.
Thank you. Perfect summary of what we've been talking about. There is one question in the chat box I'd like to ask, and it's directed to anyone and all of you, if whoever wants to jump in. Is there 100% vesting and no cliff vesting? Is it portable for rollover to an IRA or another employer plan?
Well, vesting is still permitted. So there's nothing wrong with having a vesting schedule. To some extent, if you have high turnover, I recommend a vesting schedule, because why be making contributions for short-term employees, whether it's profit sharing or match? The 100% vesting tends to be more common when you're having a safe harbor plan, because you're trying to pass testing and you're giving away the money. But again, as Allison said, there's nothing wrong with the reach match. There's nothing wrong with eliminating the match and going profit sharing. But as Brian said, you need to periodically review all of these things, because we get set in our ways. 50 cents on the dollar up to 6. A lot of companies have just had it for 15 years. It was a great contribution 15 years ago. But if you haven't reevaluated automatic enrollment, automatic escalation, changes in your design, then this is the perfect, as Sally said, perfect time to hit the reset button.
The portability too factor, I'll jump in on, because I think
Please
that
do.
might have been relating to the Roth contributions. So when you do make any kind of a Roth contribution or an in-plan Roth conversion, you do have the ability to roll it out into a Roth IRA. So if you terminate employment or you've just reached a distribution event, then you do have the ability to roll that out into an IRA. And then I also mentioned that there are provisions you can add into your plan where you can do rollovers of mature match or profit sharing money out to an IRA before you're 59 and a half. So you can be a 40-year-old and roll out if it's mature. So if some creative plan design or creative investments are desired within your organization or with the people you work with, then you have to think about to what Brian's saying, does that investment make sense in your plan? If it doesn't make sense, then maybe you can structure a plan design where they can roll their money out and use Roth dollars to invest in other things outside of the plan.
Thank you. Anyone else want to hop in?
I'll just add to one quick thing, because I think
Sure, please do.
Allison made a great point before around that stretch match, and she gave you that a great example of, that savings of over $300,000. And then you talk about vesting, right? And I don't think we even talked about that piece, but now if you have a vesting schedule in that plan and participants are leaving, that $1.3 million or that $300,000 savings could go to $400,000, because now you have $100,000 of forfeiture in the plan. And if your plan allows for you to use that money for offsetting contributions, right, there's some additional savings there. So again, all good ideas from a plan design perspective that, can be discussed as part of your ongoing committee discussions.
Just
Great,
another
thank
quickie. Just
Oh,
another
please do,
quick-
right. Take your time, Frank, go ahead.
No problem. Well, we're bulleting a few fast things. Liz probably didn't get to this. It was probably on her list of the 5. But if you've had layoffs during 2020, which a lot of companies have, and you haven't rehired those people, you have to give consideration as to whether there was a partial termination, and those individuals should have been 100% vested. So for those of you that will be audited by Liz, that's going to come up. For those of you who don't have audits, you do need to take a look and see if you've had more than a 20% reduction in your participation. And then, not to beat the dead horse, but on the Roth conversion, this is the perfect year for a lot of you to do it. We even have clients who are borrowing money to cover the taxes that are associated with the conversion. So, you're at a 36% rate. You're a senior exec. You never did Roth because you always thought you were paying too much in taxes. This is really a good opportunity to say, maybe I should convert 50,000 or 100,000, pay the taxes on it in 2021, when we know our rate, at least we hope we know our rate, is 36%. And if it goes up to 39.6 next year, you've taken real advantage of the plan. You do need an amendment to your plan, because most plans don't have an in-plan Roth conversion feature, but Allison and her team can help you do that relatively easily.
Thank you, Frank. It's been a very fast-paced hour, and I'm really surprised, and I'm hoping that everyone else that is listening has had the exact same experience I don't think you could have avoided, and that is you were able to take a macro idea, talk about not only the impact of COVID, but in general and specifically about retirement plans, employee benefit plans, and then bring it down to a micro level to individual cases, individual examples that were practical and applicable for everyone that's on this call. So the ability to take a great amount of information and then make it understandable as well as useful and relevant for the people who have joined this call today is remarkable. And I cannot thank you enough for the time you put in, the preparation you put in, and your thoughtfulness about the way that you presented your unique perspectives. And I even we love the way that they also had some overlap, right? Because it's an integrated plan. There is an audit component, there's a tax component, there's investment component, there's a legal component, there's a record keeping component. So it's really nice that you were able to do that and avoid any redundancy at all. It's just fabulous. We don't have any more questions. So unless anyone has one last minute observation you'd like to share, I think we'll turn this over now to Alan Sobel, our managing partner, who always has a wonderful observation to share after sitting through these kinds of programs and giving us some insight. So Alan, it's all yours.
Thanks for the pressure, Sally. I really needed
And no
that.
pressure, no pressure at all.
I'll be very honest with you. I don't have a lot that I can add here because our panel, I think, did just a tremendous job today. So I want to thank Allison and Brian and Frank and Liz and Sally for leading such a wonderful, wonderful discussion. I will say that as I was listening to the program, what kind of rang true for me as we kind of are dealing with COVID, and more importantly, as more and more people are moving to be vaccinated, that we as plan sponsors and employers have a tremendous responsibility to our employees. And I guess the analogy I would make is that maybe this is a good time to vaccinate our plans, to take a look and find ways to protect our people. So for example, Liz talked about early on in the beginning, talked about cybersecurity and the need to protect our employees' data and making sure that they're not at risk. So now's the time to kind of give a little bit of a closer look at the risks that are surrounding your cyber risks, your cyber security, and make sure that we're protecting our people from cyber risks. Allison, you talked about designing the plan to encourage and incentive people to save. I think that's so important in a time where people are underfunded in their retirement plans. So, let's put a little bit of vaccine in their arms and make sure that we're designing our plans to most effectively encourage them to save and set aside money for their retirements. Because hey, I'll speak for myself, it's coming a lot quicker than I ever thought it was when I started out in my career. Frank, you spoke about everybody spoke about a lot of things, but these were some of the things I took away. But Frank, you spoke about reviewing investment choices and the performance of plans, not just the performance on how they're doing to market, but also the fees that they are, that are being charged. And so, let's vaccinate our plans against high fees, and let's make sure that we are making good investment choices, or offering our employees, I should say, good investment choices. And last but not least, Brian, you spoke about financial literacy, and I read an article in Newsweek magazine that talked about 35% of millennials don't even know how much money to save. So again, let's provide some vaccinations to our employees through financial literacy and making sure that they're well equipped to prepare for their retirement. Another interesting statistic, I think somebody entering the workforce today will have something like around 4 or 5 jobs in their career, and will have 2 to 3 careers throughout their entire work span, which means that they're going to be jumping from place to place to place. And so it's no longer incumbent upon only the employer to provide for people's retirement. We need to educate our employees so that they are well equipped through financial literacy to help prepare themselves. Because the other bad statistic here is people are retiring underprepared for retirement, and the reliance on Social Security can just no longer be potentially what it once was. Lastly, I'll just add, this is my own observation, that with changes in taxes is going to come opportunity to make savings that much more valuable. And I know there was some discussion of Roth, but one of the things that Roth doesn't cover is Social Security taxes. And one of the Biden's proposals is for those making more than $400,000 a year, that the Social Security tax will come back into the fold. So that could be another 15% tax, making retirement savings even that much more valuable. So those are kind of just my summary observations. I do also want to take a moment and thank each and every one of you for being supportive of Sobelco. We are very much committed to this space. Our employee benefit plan audit practice is a niche practice. It is a business unit of our firm. It's not something we do on the side. Liz and her team really take this very, very seriously. And we are, only too happy to continue to grow that practice. So we are appreciative of you as clients of ours. We are appreciative of all of you as referral sources of resources of ours, and friends who can collaborate and work together to help make our companies and our people better prepared for retirement. So thank you so much for all of your support of Sobelco. We're here for you when you need us, and we know that we can count on you when we are in need as well. So I wish you all to continue to maintain safety and good health. And as we kind of reemerge from this COVID into a new norm of a world, I wish you nothing but the best. So thank you again for participating today.
Thank you.
You're all on mute as you say goodbye.
Bye. Thank you for joining.